the financial services year-end tax update. We've got a lot to cover in an hour, so we're going to get right into the program. Initially, the first 30 minutes, we're going to talk about some legislative updates, both directly in the financial services area and then state and local and international that impact financial services. And then we're going to get into some year-end planning. To kind of kick it off, I'm going to ask Colleen Fay to really discuss the new regs under 1061 regarding carried interests and some of the impact and possible year-end planning associated with these new regs from back in August of this year.
Sure, thanks, Mike. So just to take a quick step back, the proposed regulations under 1061 that came out this July, end of July, I guess, beginning of August, are the regulations referencing carried interest rules where long-term capital gain related to property held for 1 to 3 years, which is earned with respect to carried interest or an incentive reallocation, would be reclassified to short-term capital gain. So the regulations won't be effective until the start of the taxable year after they're actually finalized. Doesn't seem likely that they'd be finalized in 2020. So the earliest that we're looking at would be 2022, assuming that they are finalized in 2021. However, you could choose to follow them beforehand if you follow them in their entirety and consistently. So in the proposed regs, there are some welcome clarifications that explain certain things that are and are not subject to the rule. So for example, PFICs, RICs, and REITs are specifically included. I think a lot of tax preparers were already including that information on disclosures, but now it would be required. So an annual information statement from a PFIC would now need to disclose the amount of capital gain that is related to 1 to 3 year property that it's reporting. And on the other hand, section 1231, 1256, and qualified dividends were listed as not specifically included. So people were happy about that clarification. And as this relates to year-end planning, obviously the intention of any year-end planning that's been done over the last couple of years since 1061 was introduced would be to cleanse the carry earned by the GP so as not to be subjected to the rule for future earnings on the capital account. Most did not like the option of taking cash out of the general partner entity and holding it outside the fund for a period of time in order to cleanse it. Most of the time that period ended up being at least 30 days. And then recontributing it through an LP account. The optics for investors of the GP being out of the fund and even just being out of the market for that long wasn't really appealing. So over the past couple of years, some chose instead to do a cash distribution. Instead of doing a cash distribution, to do a property distribution. So in a master feeder structure, a manager would have a property distribution out of the general partner interest out to the individual members, and then they would make a property contribution back into the onshore feeder, usually through a new entity that was created. So basically it did move from one pocket to another, but via property distribution. There is some uncertainty under the new proposed regs whether that would be considered a transfer to a related party under 1061D, which would then accelerate the unrealized gain that's built up in the distributed interest from the GP's account. So since the proposed regs included the definition that allocations would be deemed commensurate with capital contributed if they were made with respect to a taxpayer's capital account, the movement out of the GP account that I just described may not actually be necessary if the growth on the GP's capital account, including realized and unrealized, wouldn't be subject to the rule. I think this has led a lot of people to consider no action at year end as it relates to the GP's incentive, because if the unrealized is able to grow without being subject to the rule, then those extra steps may not be necessary. So we'll see where in the priority list under Biden it would be to finalize these 1061 proposed regs, because in the end, some of this may not matter going forward depending on where they come out on that.
Thank you, Colleen. Amanda McKenna, we have, I guess, some new regs under 163J that kind of changed the methodology that was used in prior years for trader funds. Can you give us a little background on what the changes were in these final regs?
Yes, so in July of this past year, the IRS issued final and proposed regs. providing a lot of clarification impacting the financial services industry, specifically for trading partnerships. I think the most significant takeaway from the proposed regs is that now they're requiring bifurcation of material participant versus passive investors. The proposed regs essentially reverse the 2018 proposed regs that subjected passive investors, those not materially participating, to the interest expense limitation at both the fund level and the partner level. Because in the previous 2018 regs, trader funds were considered to be engaged in a trade or business activity and subject to the limitation. So comments were out to the industry asking to clarify and questioning the interpretation of whether interest expense should be subject to a double limitation under 163D and 163J. So with the new proposed regs, partnerships are bifurcating its interest expense from trading activity between those who materially participate, essentially the general partners, and limited partners who are passive. So the 163J limitation would only apply to the portion of interest expense allocable to the materially participating partners, the general partnership, or general partner, clarifying that they should not have this two sets of limitations. So while these results are favorable to the limited partners and we expect clients to opt in based on these proposed regs, it is expected to be a significant administrative burden on trading partnerships to comply with this, to properly track and allocate between passive and non-passive partners. So I think that's the biggest takeaway from the proposed regs. A second takeaway is the treatment of excess business interest expense, EBI, in a tiered partnership. So for example, your master feeder structures or in the fund-to-fund context. This wasn't addressed in the 2018 proposed regs and now has been addressed in the recently released one and is out to the industry for comments also. So without prior guidance on this, the industry was either taking an aggregate approach or an entity approach to account for EBI in a tiered partnership. So the new regs would take an entity approach to tiered partnerships, providing that if a lower tier partnership allocates EBI to an upper tier partnership, so essentially your master fund allocates to your feeder, the EBI is carried forward by the upper tier partnership, the master fund, rather than the feeder. So in the proposed regs, they didn't provide a transition rule for how this will be treated going forward. And this could be also, something to look out for of how we're going to do this transition, because it does add a level of complexity if you haven't been tracking at the entity level previously.
And they're still making you go through the 11-step process for purposes of the actual calculations?
Yeah, so unfortunately, the 11-step process did not go away. They do say that there's an exception if you allocate everything pro rata, but that's not going to work for our hedge funds, our trading partnerships. So unfortunately, that is still out there. These regs will go into effect, same thing with the 1061, either 60 days after they've been finalized, or you can elect to opt in earlier as long as you apply them consistently. One last key takeaway, this was in the final regs, was that the IRS narrowed the definition of interest, meaning that fewer items are going to be subject to the limitations, so larger business interest expense deductions may be allowed. They also made exceptions for cleared and non-cleared swaps. They delayed by 1 year the applicable date of the embedded loan rule. And they also excluded some things from the definition of interest, including certain substitute interest payments, commitment fees, debt issuance costs, guaranteed payments for the use of capital, and income deduction gain or loss from hedging transactions. So I think while we see that most of these outcomes in the proposed and final regs for 163J are favorable to the taxpayers and our clients, it will be seen how fund managers and tax practitioners will practically implement these changes going forward.
Thank you, Amanda. Josh Pagano, we've got we had proposed tax capital reporting in 2019. It got close to filing season, and it got extended for another year. And now they recently came up with some clarification on how to do it. you just give us a little update on where we stand regarding tax basis capital reporting?
Yeah, sure. Thanks, Mike. So yeah, a couple of weeks ago, the new 1065 instructions came out, and it seems as though we are moving forward with tax basis capital. They even said the other day that they don't expect many changes with the instructions. So I think we're moving forward. Back in 2018, negative tax basis started being required for partnerships. If any partner had negative tax basis, you had to report it in the beginning and ending on the K1. So in 2019, like Mike was just saying, this came out that we had to report tax basis, but there was a lot of pushback from taxpayers and accounting firms that it would just be too much of a financial burden to do it that quickly. So I think a lot of people were hoping it would be pushed back a little further, with everything going on, but it looks like we're moving forward. So the 2019 instructions had a couple of different methods of calculating tax basis, but the new instructions, the instructions that we expect to be final only have one method of calculating tax basis. So this is called the tax basis method, which is basically just the transactional approach, which they kind of said last year, which this is your standard way of calculating tax basis, looking at a per transaction, per partner basis. So you look at your contributions, your distributions, taxable, non-deductible items, and it's very specific to each partner. That being said, there's only one method to calculate tax basis once you hit 2020, but to get to your opening balance in 2020, there's 4 different methods to get there. So there's some potential for a shortcut. So the 4 methods are, one was the transactional approach, which I just talked about. So if you have a hedge fund or an entity that has had tax basis in the past, but we're probably already using that. The other one is the 704B method. So if you use 704B allocation rules, you can use that. Another one is the modified outside basis method. So this would be using the outside basis. You also said that you need to take out section 752 and section 743 basis adjustments. So it's a little complicated, but you need to make adjustments to that. And you can use the outside basis that partners calculate. So if partners are calculating their basis outside the partnership, that is allowed to be used. You obviously have to adjustment, like I just said, but it's not required to use the outside basis of the partnership. And the 4th one, which is kind of interesting, it's called the modified previously taxed capital method. And this is based off a hypothetical liquidation. So you take the tax basis of the partnership assets and you divide them their pro rata share between all partners. This might not work in every scenario. Your capital, your profits, and your loss would probably have to be equal. This is a potential shortcut, but something you need to look into. So there's 4 methods to get there. Once you're in 2020, there's only one method. As far as reporting goes, in the bottom left section of the K1, it's box L. That's normally where your capital is. That is no longer going to be the capital. That'll be your tax basis capital. So those numbers will be your tax basis. It's not required to have a footnote with your ending capital balance, but there's some discussions that that it will be provided on a footnote, but there's nothing in the IRS saying that you have to do that. But that was usually the only number that an investor could tie to anyway. So I think it would be, kind of a lot of people might be putting that on the footnote. So that's as far as the K1s. As far as the tax return goes, those are familiar with the 1065, page 5. You show your balance sheet on a GAAP basis if you have GAAP financials. But down in the M2, which is another section that used to show your capital balance, which it was a perfect check between checking your balance sheet on GAAP and then you check your book basis of your partners at the bottom, and those numbers always had to tie. And now there's going to be a mismatch, so it's going to be a little harder for both clients and taxpayers to review because you're going to be mixing these tax and book numbers. There's going to be a mismatch between the two. So I only have a couple more seconds here. So the main thing I just wanted to say is that you need to start looking at this now. There's only about 2 months till tax season, and those 2 months are going to go very quickly, and I've been calculating tax bases for some of my clients that haven't tracked in a long time, and it's very time consuming and a heavy burden. So please reach out to your taxpayers if they haven't reached out to you. I mean, your tax preparers if they haven't reached out to you yet, and get on top of it before we get into the heat of things.
Thank you, Josh. I guess one of the biggest and hottest topics that have come out with our clients' discussions over the last couple of months has really been the state and local aspects of COVID and how to deal with, you know, employees who are telecommuting and what's the impact to, you know, a bunch of various state and local apportionments and state and local filing issues. So Jason Rosenberg is going to here to kind of tell us a little bit about what's happening, you know, at the from the employee level all the way through to what happens from a New York City UBT perspective for management companies that may have people working outside the city. Jason?
Yeah, great. So, you know, as COVID continues, you know, to disrupt workforces, this has really put a renewed focus on state tax, as Michael mentioned, stemming from telecommuting. You know, for many businesses, right, a lot of these issues have been prevalent, but COVID certainly broadened, you know, the reach of this now that every business has employees working remotely. So from a state perspective, we're seeing 3 core issues, and let's kind of, you know, think about them and go through them, you know, real briefly. So first and foremost, right, income tax nexus, sales tax nexus, right? But for us, you know, when we think about income tax nexus, you know, in respect to telecommuting, it's relatively straightforward, right? Where the presence of employees in a state is always going to result in nexus unless a specific state is providing COVID-19 relief for, you know, as a result of having a temporary employee within the state. So while some states are providing that relief, many states have remained silent and appear, you know, that they will not be providing any relief. And you know, kind of in conjunction with economic nexus, right? That relief would not apply if the company would otherwise have economic nexus. So we're not seeing, you know, as much value as we would like to see with some of that temporary relief that might be provided from some of these states. Second, in terms of some of the issues that we're seeing when we think about telecommuting, is income tax apportionment, right? And as many of you already might know, apportionment, which is essentially taking a state's formula, which is used to divide or allocate taxable income amongst the many states based on business activity within a state. So in some states, the consequence of an employee working from a different state as the result of the pandemic could affect sales sourcing and the payroll apportionment factor for the states that still use payroll apportionment within their apportionment factor, although it is dwindling. So for example, New York City UBT, which is imposed on non-corporate entities, it uses cost of performance type of sourcing, which essentially sources sales to the state based on costs being incurred within the city, such as payroll costs. So New York City sourcing rule is generally going to be determined based on where the services are performed, opposed to where the customer might be based. So, you know, considering the COVID-19 landscape is certainly resulting in more employees working outside the city, this has presented many New York City businesses with the opportunity to potentially mitigate some of these taxes. So sourcing, you know, as I mentioned, right, it's going to be generally determined where the services are performed. So there might be, you know, consideration with not just New York City, but any state or city jurisdiction that uses similar type of sourcing methodology. There could be potential opportunity there. And the last core issue that we're, you know, seeing with telecommuting is state payroll tax withholding. Traditionally speaking, right, most states source employee wages to the state where the employee performs the services. And then unless there's a temporary COVID-19 relief in a state, if an employee is working in the state, let's say, for example, you have an employee that's now working remotely in Maine, then traditionally speaking, a payroll tax withholding obligation would be required unless the state of Maine provides special COVID-19 relief. In contrast, the traditional wage sourcing rule, some states apply what we call a convenience of employer rule, which New York is one of those states, for example, that has that rule. And these rules essentially require non-resident wages to be sourced to the office of the state where the employee is assigned, opposed to where they're working, right? Traditionally, most states, as I mentioned, that's going to be based on where the employee is performing services. New York, under the convenience of employer rule, will be based on where the employee is assigned. So this could potentially result in double withholding requirements for the employer. Employers certainly should be proactively developing policies that are aligned to some of these risk management issues. Now, in terms of the convenience of employer rule, I know a lot of businesses are asking, well, can we just simply reassign the employee to another office or treat that employee's home office as the assigned office? Because a lot of our clients have multiple offices. They might have a primary headquarter office in New York, and maybe they have a satellite office in a neighboring state, or maybe on the West Coast, right? But generally speaking, when we think about the convenience of employer rule, the assigned office is based on the location where the employee reports to. So you would consider, factors such as location of the employee's direct reports, location of where the annual performance reviews take place, location of employees' department. They might be part of, depending on what department they are. If they are historically been in the New York office, right, we got to consider these host of considerations. It's not necessarily just a change on paper. It is also looking at where, in reality, where that employee would be asserted to be based or assigned to. Now, that being all said, just kind of as a caveat to all of this, or just kind of as a notation to all of this, I should say, is that New York looks like they're going to be very aggressive on the convenience of employer rule. The state issued guidance last month suggesting that even in the midst of the pandemic, that the rule would still apply. Unless a telecommuting location is established as a bona fide employer office. So, just to kind of as a takeaway with all of this is that, the convenience of employer rule, New York has been super aggressive with it. And based on the guidance that they provided last month, it looks like, they're going to continue to most likely provide in a very aggressive view. So for our clients, taxpayers, right, that have offices in the New York office with significant employees now maybe working in Connecticut, New Jersey, neighboring states, or elsewhere, that needs to be looked at. And some of the things that we're suggesting to clients is to make sure that they're developing policies around remote work, make sure to connect all stakeholders, that HR is involved, legal is involved, finance, and so on. And then just making sure you are able to obtain a good understanding with your employees where they're working from, which is equally important. And then really just bottom line is analyzing what the potential compliance operational costs are and just staying up to date. And, and that will help hopefully mitigate some of these concerns. Now, my last couple of minutes here, I just want to also mention, I briefly mentioned before about New York City UBT tax, which is a super, super important topic, especially for our clients based out of New York. And, there is some tax strategy around potentially reducing New York City UBT tax as, employees are working remotely. And certainly within the financial service space, right, a lot of our clients are organized as a non-corporate entity. And so, as many of you know, right, you're taxed at the entity level opposed to it being flowed through to the owner level. And so those costs could be, prohibitive at times. And what we're certainly seeing right now is that businesses that had a significant presence in New York City before the pandemic began might have the opportunity to allocate income outside the city. So again, when we think about New York City, right, the city generally sources using a place of performance methodology. This is in contrast to, provisions that oftentimes when we think about cost performance, some states, some jurisdictions will source based on the office where personnel are situated. New York City has a unique sourcing provision. So again, there's could be a potential opportunity there. The burden of proof is going to be on the UBT taxpayer. So it's important for businesses to consider how to track and substantiate employee work locations in the event that New York City were to inquire on the methodology.
Thank you, Jason. Josh Galenter, the Tax Cuts and Jobs Acts have been around for about 3 years, and GILTI has been fully entrenched in our vernacular. What's the impact to our financial services clients from GILTI at this point?
Thanks, Mike. Yeah, so in the couple minutes we have left for the tax update, let's just do a quick update as to what's gone on with GILTI over the course of 2020. There have been a couple of major updates as far as final regulations that have been promulgated this year that impact in the financial services space. Most particularly of interest is the fact that under prior law, when you had a flow-through entity that was the shareholder of the controlled foreign corporation, the GILTI amounts were calculated at that entity level and then passed through pro rata to the shareholders, or the partners rather, in that flow-through partnership. That is now no longer the case. And the way things are going to work now and for the future going forward is everything's going to be calculated at the individual level or at the partner level up top, to the extent that if you have a situation where you have partners who own less than 10% indirectly in the CFC, they will not have a GILTI inclusion under the new rules. Rather, only 10% indirect shareholders through the partnership are going to have GILTI related pickups and filing requirements. That's a major change to the way things have been done before, whereas now we're going to have a whole segment of the population who prior to this change were required to include GILTI and file the requisite forms for the GILTI inclusions with their returns. Now that is no longer the case. It's going to be disclosed in a footnote to these individuals that they may have a GILTI inclusion depending upon their shareholdings, and if, like I said, if their shareholdings is less than 10% in an indirect way through the partnership of the CFC, they will no longer have a requirement to include anything under GILTI. The other major change to GILTI is the high tax exception, which was introduced under the proposed regulations in the final and in last year under proposed regulations, with the note that they weren't allowed to be relied upon until those regulations were finalized. Those regulations were in fact finalized earlier this year. So now we have a high tax exception that basically says that if you have income coming through GILTI from a jurisdiction where in that local jurisdiction the income had been subject to a tax that is equal to or greater than 90% of our current corporate tax rate. So that would be if it was subject to a rate of tax in the country of 18.9%, then that is eligible for the high tax exception, and the shareholder is allowed to make an election to exclude any and all income that's flowing up from the foreign corporations. Under GILTI, they're able to elect to exclude that. Now that's it's an all or nothing election. You can't pick and choose which entities and which countries you make that election on, but it's really a modeling exercise where you figure out what the best result is, whether you make that election or not, and you're able to either at your by election to exclude any GILTI income that would flow up. The last major thing that came out during this year, which is not relevant for now, but is something to keep our eyes on a go-forward basis, is the IRS introduced proposed new schedules, international schedules, Schedule K2 and Schedule K3, that's supposedly supposed to help streamline and ease the international tax aspects of reporting as it relates to partnerships, which obviously would have a major impact on what we have to do as practitioners as far as the compliance requirements. Now, this is again proposed now for the 2021 season, 2021 tax year, for the 2022 filing season, so we still have a ways to go. The reason why they put it out early is because there's a lot that's going to need to be done in order to make those new schedules more user-friendly, so they put them out early so that there's time for comments and for the IRS to go ahead and finalize those in a more user-friendly manner. So that's just something for us to keep our eyes on a go-forward basis. And with that, I think we have completed our
Perfect.
tax update.
Thank you, Josh. Thank you for this whole panel. We're going to switch over to our second panel, which is more about year-end planning. So my first question I'm going to target for Dalia Ayala, and it's really around, really hedge fund trading planning. Obviously, you get closer to the end of the year, people want to make sure that they're doing whatever tax trading they need to at the fund level. Dolly, what are some of the normal things we look at from a tax trading perspective with hedge funds regarding going into year-end planning.
Well, thank you, Mike. So as we go through our ending process of looking at what's going on in our portfolio, we want to look at our book to tax. And basically, commonly, we can find that sometimes our tax is running ahead from our books. So meaning that we're down for books, but we have taxable income, which is not the great scenario for our investors, since we don't want them to have a tax hit without having actual income. So how can we fix this? And how you mentioned, Mike, we have some traditional tax trading strategies that can help with the disparity between the book and tax. And one step that we can take is to look and see when is a proper time to recognize gains or losses. So when you do that, you want to look at what your positions are in 2020, and then maybe also look a little bit ahead, even though that's really tough, at your 2021 positions, to see what is the preferable recognition of gain and losses. Now, we know that our market has been volatile, and so even so, we do see that there's some funds that have positive performance with the same having those that are underperforming. And you may find yourself looking at your year-to-date analysis and having a lot of gains, but also having unrealized losses in your portfolio on securities that you want to keep in your portfolio because you think in the future there'll be some benefit and gains on those securities. So in that aspect, you want to harvest your unrealized losses. But there's something that you need to take into consideration. There are wash sale rules, and they're very easy to trigger. Basically, by just realizing those losses in your holdings report, you would go into the security again, and that would trigger a wash sale. So we're going to look at 3 examples that may help in that aspect. The first one is doubling up. It's exactly what it means. You have the portfolio in your holdings report or in your portfolio, and you go into the security again. Now, that works for tax purposes, and you have to wait a minimum of 31 days so that you don't trigger the wash sale. But it doesn't help because it doubles your exposure. So it's not the ideal example here. We can alleviate that double risk by maybe doing the same thing, doubling up, and then going into a call. But if you do a call, you want to structure that as a qualified cover call so that you can avoid going to the straddle rules, which is another deferral that the IRS has as far as losses. So that will defeat the purpose. But you can go in as many calls as you would like to diminish the risk to that one-time exposure in a 31-day period. Something else that you can do is that you can sell the unrealized loss position that you have in your portfolio and go into a put. And you may think, well, why not go into buy a call? But that would automatically trigger the wash sale rules, which we want to avoid. But that wouldn't happen with puts. Now, one thing you need to consider is that you cannot be too far into the money with the puts, because if you are, the IRS will just say, well, you're really in the security, so you are as if you exercise it even though you didn't, and then it would trigger the wash sales rules again. Now, what's crucial here is the timing. We're very far into the year. So if you hit December 1st, at that point, you will not be able to take it into your planning these strategies because you obviously need 30 days for these to work. So timing is essential. And lastly, I just wanted to talk about box trades because that's an alternative. And again, you'll look at your book or tax to see what is best for you, either recognizing the box gain or deferring to the following year. These are under constructive sales. And the good thing about this is you have until January 30th to cure them, so to release the box gains. But you have to make sure that you're unhedged for 61 days. Here, the taxpayer has control over the timing up to 90 days after year end, which is really good. Lastly, again, all of this is circumstantial. It depends on the fact patterns, the timing, whatever you have in your portfolio will definitely have an outcome. So absolutely talk to your tax advisors to see what's best for your circumstances. We want to partner with you to make sure that whatever goals you're trying to achieve, we can help you and to get to that optimal goal. Back to you, Mike.
Thank you, Dolly. Anthony Anello, aside from trading strategies to kind of year-end plan, are there other opportunities within the fund structure that we could do some year-end planning around?
Sure, thanks, Mike. So when we look back to this past year, it's pretty obvious the markets were materially impacted by the uncertainty of COVID-19 early on, and the volatility is still front and center. I mean, look at the markets today. So it has certainly been a unique year, and funds may have taken different approaches to navigate or weather this volatility and mitigate risk. There could have been increased or decreased trading volume, different hedging instruments, or altering investing strategies to maintain the investment returns of previous good years. When you take all that into consideration, I'd say that there are 2 or 3 year-end planning opportunities that do come to mind that could be more beneficial this year to explore. First, sending out year-end estimates to your investors, paying close attention to trader versus investor status of the fund, and then furthermore, potential elections the fund can make. So first, year-end estimates. They can be very beneficial for multiple reasons. The greatest advantage is that they allow the fund to manage investor expectations and the GP for that matter. Again, given the volatility and different approaches a fund may have executed, there could be great discrepancies in book and taxable income as it relates to unrealized and realized gains and losses. Estimates can really help in this matter and eliminate any unforeseen surprises for investors and manage those expectations. The fund can start evaluating tax adjustments of the current year and any reversals of the prior year through the cutoff date, which could be at the end of October or November, is typically what I've seen. And as Dolly has explained, the fund could execute different trading strategies if needed to help address different scenarios to recognize gains and losses. Also, considering the uneasiness that investors may be experiencing in the current investment climate, the fund may have encountered a year where there were more full redemptions in the fund compared to prior years. Thereby, estimates will give the fund a head start in reviewing the potential impact of a fill up or fill down provision for allocation of gains and losses. And if the agreement permits, any fill up, fill down on partial redemptions could ultimately result in less gain or loss allocated to the other partners. So going back, secondly, going back to market volatility and potential increase and decrease of trading volume, it's really important to assess and test for trader status of your hedge funds, especially important for those funds that may have historically fallen in or fallen out of trader status in the past. Remembering that a fund that qualifies for trader status in securities has certain tax benefits, primarily the deductibility of expenses treated as trader business expenses under Section 162, instead of expenses being treated as portfolio expenses under 212 for an investor fund. And we do realize that those portfolio expenses are no longer deductible to investors except for corporate entities since tax reform. So given that there's no statutory bright line test for qualifying for trader status, industry practice is typically to run different tests to analyze the trading activity to substantiate that it rises to this level of a trader. And we typically do this by looking at total trading volume, number of trades, average holding period, the number of days traded, and even portfolio turnover ratio, just to name a few. And lastly, I'd say the third consideration is the fund may consider certain elections to put in place that may be advantageous for tax purposes based on their trading strategy and their potential outlook on the markets. First is the Section 475 F1 election for those funds that qualify for trader status. This election allows funds to mark-to-market their portfolio of securities and treat gains and losses as ordinary business income or loss instead of capital treatment. The biggest benefit here being the trading losses are fully deductible now and not limited to the 3,000 net capital loss limitation at the individual limited partner level. And then finally, for those funds trading in foreign equities and using currency forwards to hedge against currency fluctuation, the fund can explore the benefits of making Section 988 A1B election. Since currency forwards under 988 regime are taxed at ordinary rates, this election allows taxpayers to get capital gain treatment, effectively treating the forwards as 1256 contracts and getting 60% long-term and 40% short-term capital treatment. So all in all, those are a few considerations for the funds that I think are rising to the top and worth exploring under these turbulent market times.
Thank you, Anthony. Kristen Stinson, you work very closely with general partners of funds doing their personal planning and also with management companies. Obviously, there's a lot of things to do around year-end, doing year-end projections for general partners, and sort of what planning can be done at the management company level before year-end, based on whatever their structure is. So what are some of the things you're talking to clients about?
Sure. So for the most part with management companies, our year-end planning discussions usually focus around two questions. What expenses can we accelerate into this year, and what income can we defer into the next? So there are a few things a management company can do to accelerate expenses. The first is through the bonus depreciation. A management company can deduct 100% of the cost of fixed assets for the first year they are placed in service. Such assets include, but are not limited to, office furniture, computers, etc. In addition to bonus depreciation, Section 179 deduction is also available, which essentially does the same thing as bonus depreciation, allowing for 100% deduction in the first year the asset is placed in service. So does it really matter which method you use? Well, it does. Some states limit bonus depreciation, such as New York, but allows 179. 179 also has an expensing limit of $1,040,000, and total equipment purchased by a business cannot exceed $2,006,000 for 2020. So once it exceeds that amount, the deduction is reduced dollar for dollar. 179 can also not be used to create a loss or increase a loss. So there are differences between the two, and you just kind of need to focus on your current situation and your facts and pick the one that's most advantageous. They also can be used as a combination. So you can use bonus depreciation on some assets and 179 on others. For 2020, charitable contributions, the limitation on corporation deductions decreased from 10% of taxable income to 25% of taxable income. And this is for 2020 only. So if your corporation is charitably inclined, you may want to take advantage of this new change. Additionally, if you're a management company that is subject to New York City tax, going along the same lines with charitable contributions, you may want to make a charitable contribution to the management company so that you will reduce the 4% UBT tax. Just keep in mind that the charitable contribution cannot exceed 5% of your total New York City income. You can also especially allocate the charitable contribution to the partner if the donation was partner specific, so that it will be reported on that partner specific K1 and obviously deductible on their personal return. Speaking of taxes, we would recommend paying any UBT tax liability or any other state entity level tax by 12/31 to receive the deduction in 2020. Depending on facts and circumstances, there may be some opportunities, as Jason Rosenberg mentioned earlier, to allocate income out of high taxing states. For example, if in New York, if a GP or owners are leaving the state and setting up a home office or an office outside of the state, they are in fact the decision makers and revenue drivers. They can also allocate out at some point, but obviously facts and circumstances are different for every client and individual, so we kind of need to evaluate that a little bit further. On the individual side, it's helpful to think of tax planning over a 2-year period, especially important if your income fluctuates year to year. Ordinary income is taxed at 7 different rates, as you may know, depending on the amount of income. And the capital gains rate that an individual is subject to is based on their taxable income. So if you're in the 20% bracket, your income is usually over $496,000 for a married filing joint person. And if you fall into the 15% capital gains rate, your income ranges from about $80,000 to $496,000. So if you think you may have lower income in 2021, you may want to hold off in generating additional capital gains in 2020. This is assuming that the rates are going to be known by the time January rolls around. And I don't even know at that point it's still, because the Senate, I guess with Georgia going to a runoff. So who knows what's going to really happen in 21, but just looking at 2 years can definitely help you to see if there's more advantages in recognizing income in 2021 or doing so now. Also knowing your tax picture. If you have capital loss carryovers coming from the prior year, or if you have passive loss carryovers coming from the prior year, it can also help with planning and the types of income that you may be able to generate. Given the obviously this $10,000 limitation on state and local income taxes as a deduction for the past few years, a significant amount of taxpayers are forced to take the standard deduction. One way to maximize the amount of itemized deductions is to develop a bunching strategy, basically accumulating charitable contributions or medical expenses even from 2 or more years into 1 year. So for example, if you have a taxpayer that hasn't made any charitable contributions in 2019, they may want to double up in 2020, therefore pushing them forward and surpassing that itemized deduction limitation. What else? So that might be a strategy for someone to develop, maybe not give charitable contributions in 1 year and double up or increase them in another year. For 2020 though, there is no AGI limitation on cash contributions. So you can give 100% in terms of charity equal to 100% of your adjusted gross income. And this is only for 2020. In addition to that, if you're a taxpayer that does not itemize, there's a $300 above the line charitable contribution donation deduction that you can take also. And then there's some planning ideas around charity. If you fund the donor advised fund, which is essentially a charitable investment account set up at most financial institutions, and you can fund it with cash or securities and select charities to donate, which does not have to be done immediately, but the deduction is immediate. So if you would, whenever you fund the donor advised fund, the deduction's immediate, but you can select the charities later. And just one thing to note on the donor advised fund, they are not they're still subject to the 60% AGI limitation, so they don't go against the 100% that we just mentioned that you can deduct. Gifting low base appreciated stock that you've held long term, that's another great thing to do in terms of maximizing a deduction for charitable purposes. You'll get the benefit of the deduction at fair market value, but you will not pay the tax on the capital gain. There are definitely more sophisticated techniques when it comes to charitable planning. There's charitable remainder trust, charitable lead trust, which we can assist with, but it's beyond the time allotted for this webinar. Another simple thing you can do is pay 2020 mortgage that's due in January 21 to accelerate the mortgage interest deduction there also. A couple of things on gift tax planning. A lot of clients are taking advantage of maximizing their lifetime exemption, which is $11.58 million in 2020. So collectively, if you're married, it's about 23.16 million that you can transfer with no gift tax consequence. Additionally, you can make annual tax-free gifts up to $15,000 each year. I guess a great planning tool would be gifting assets that you believe have the potential to appreciate in the future. And it's actually, a lot of times it's usually done through a trust or a grant. And again, we can assist with that a little bit beyond the scope of getting into the details of that. But just so everyone knows, it seems like a lot of people are taking advantage of getting this 11.58 or 26.3, whatever your marital status is, done this year. So a lot of attorneys are turning down work. We have clients that can't find an attorney to draft documents. So if you're interested in maximize your lifetime contribution, whether this year or relatively close to in the future, you might want to get that set up and get that started legally, just so all your documents are in place. And lastly, there's still the same kind of deferral income mechanisms that are available last year. Like-kind exchanges are still available for the exchange of real estate, opportunity zones, investing in capital gain deferrals, that's helpful, and installment sales, deferring gain until payments are received. A couple of things to note from the CARE Act that's worth mentioning. There's an opportunity for businesses to amend their returns if they have NOLs from 2018, 19, and 20. There's now a carryback that was eliminated prior, so that's back, and a lot of people have been taking advantage of it, depending on how significant the rates were as compared to what they're paying now. For individuals, the excess business loss rules have been temporarily suspended for tax years till after 31/20. So that's another thing, that people are maximizing losses now, where they were limited to 500,000 married filing jointly versus 250 for a single person. So there's definitely a lot of planning to do, given the changes in the law, the CARES Act, and just kind of weighing out what your income is going to be this year or next year, and just kind of playing it between years to maximize the efficiencies.
All right. Well, thank you, Kristen. Last up, our closer here from our kind of lead federal tax policy person, Dan Mayo, is going to give us his take on what to be conscious of regarding, the political elections and kind of where things stand and what planning may be done over the next few months before year end and what things may look like going into the future. So Dan, take it away.
Great, thanks, Mike. Good to be here. Those are a lot of great suggestions I heard from Dolly, Anthony, and Kristen. Kristen, a good point that you mentioned about the estate planning and lawyers are too busy to do the work. I would caution people, if you're going to do that, the accounting firms may get too busy too, because valuations need to be done for a lot of these planning techniques. So that can take a few weeks to get a valuation done. So if anyone is thinking of some estate planning to use up the exemption, now would be a good time to engage, to come to us and say we need the valuations. We can get started on it sooner rather than later. Okay, so in the remaining time, we thought we'd focus on the political landscape, where we are, where things might be going. As we know, Joe Biden's been elected. He's now the president-elect. He's passed the 270 vote hurdle. Donald Trump has indicated he's going to contest the election in a few different states, although many experts believe that the lawsuits, even if successful, wouldn't turn enough votes to sway the election. The Senate is where the action is these days, and everyone's concerned how that's going to play out. It looks as if there's going to be a divided Senate at this point. It's now 48-48, and there's 4 seats open. 2 of the elections are leaning Republican. I think it's Alaska and North Carolina, I think, is the other state that's still open, but they're both leaning Republican, which leaves 2 more, which are the Georgia seats, which Kristen mentioned, are both going to a runoff in January of 2021. But Georgia is a historically Republican-leaning state, so the Democrats have an uphill battle. But if they do gain those 2 seats, they would have a majority, even though there's 50-50, because everybody will recall from high school civics class that the vice president gets to cast the deciding vote in the event of a tie. So they only need to get to 50 to have control. And given that Democrats say they also control the House, they would then have control. The markets have been going crazy the last couple of days, particularly today. Now that a vaccine's been announced, that Pfizer had successful results on its vaccine. But part of the reason the markets have been doing well is that the markets are factoring in 2 things. One is Biden comes in, stimulus likely to be larger than it might otherwise have been, and 2. Not just stimulus, but the fact that there's a divided Congress. So if there's a divided Congress, the thought is that Biden would not be able to enact tax increases and some of the more progressive elements of his party's progressive agenda. So, divided government's actually good for the markets here because they're not predicting large, large spending increases and large tax increases. So that's partly what's been driving the the change. So let's assume for the moment there's a divided Congress. What does that mean? That means that you're going to have sort of a moderate, Biden administration. Think of it as center left, right? Because they're not going to be able to enact more progressive items. You're going to need, bipartisan support for legislation they pass. And so, sweeping tax increases are highly unlikely. There probably will be some selected ones here and there as part of the negotiation process, but not likely to be major tax increases. I think in this type of situation, we can expect a lot more executive orders and regulatory change, right? Similar to what President Trump has done the last 4 years with the, sweeping executive orders and regulatory change on the, on the agenda. So in terms of taxes going up, I wanted to mention one other point too about the stock market. There's a study results of the last 70 years, and they say markets do better when there's a Democratic president. Markets do better with a divided Congress. And so I have the stats here. If there's a divided Congress, the markets on average go up 13.6% with the Democratic president, as opposed to if you have a Republican Congress, they go up 13%, and if you have a Democratic Congress, they go up 9.3%. So, the statistics do favor a better market with the divided Congress. So in the few minutes left, I thought I'd talk about the likelihood for tax increases and what they may be under a Biden presidency. And so we know that Biden has been talking about raising rates quite significantly. I think the original estimate was $4 trillion for his various tax increases. That's been reduced as a result of COVID estimations. I think it was down to 2.4 trillion was the last number I saw. But again, with the divided Congress, almost none of that is likely to come to fruition. We know that tax legislation must originate either in the Senate Finance Committee or the House Ways and Means Committee, and then it has to be approved by both houses of Congress before going to the president for signature. So with the divided Congress, the president's agenda is likely going to be stalled for the most part. So we're not likely to see the long-term capital gain and qualified dividend income rates go from 20% to 39.6, which was one of the significant proposals for the financial services industry. Other things he talked about were phasing out the qualified business income deduction for taxpayers making more than 400,000, phasing out itemized deductions for people making more than 400,000, adding the Social Security to the 6.2% portion of FICA to income over 400,000. Presently, it's capped at 137,700. One of his proposals would add the tax, add a 6.2% rate to all income over 400. And finally, he would increase the ordinary income tax rate from 37 to 39.6. So a lot of these things are probably off the table if there's a divided Congress, just because it's not a Republican position for these things to take place. So with that, I'll turn it back to Mike, or if I don't know if there are any questions, we can talk about some details or other issues relating to taxes.
I guess, Dan, the only question maybe I have for you is, I guess the Democrats may have plans to do, some infrastructure type large projects. Will they likely use, pay for provisions in some of the areas that he's kind of focusing in on sort of additional taxes? Is that one possibility of even in the future to have just increased taxes based on some of the things he wants to accomplish from maybe an infrastructure perspective?
Well, both sides talked about infrastructure, right? We heard from the Republicans, they were talking about infrastructure for the past 4 years. They just never got a bill done. So it's likely there'd be some bipartisan support, but you're right, how they're going to pay for it. And that's going to be, right, the devil's in the details, and the Democrats obviously going to want some large, tax increases. The Republicans are going to resist it and suggest spending should be cut elsewhere. Each party often has adheres to their party's ideals religiously when the other party's in office, right? When your party's in office, they ignore what they've been saying for years, but when the other party's in office, they stand by their principles. So
that is true.
Yeah, and I think that's likely going to happen here again.
All right, good. Well, we have a couple questions. We'll probably just email back. I think we've gone through our time at this point, but I'd like to thank this panel for their contribution. And if you have any questions, please email us and we'll follow up directly with you on any questions you may have. Thank you, everybody.
Thank you.